Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills. This is a little bit unusual to be back and recording another podcast.
This is true. We've had a bit of a break because Andrew is now the proud father of a baby girl. So congratulations, Andrew and Stacey.
Yeah, thanks, Bills. Thank you. It's definitely a very exciting time and yeah, it's been pretty amazing. So it's a little bit weird and I feel like I am not quite up to scratch. So apologies to everyone listening to this podcast if it isn't like our normal ones, because yeah, it's been a few weeks since I've been talking about finance, obviously still looking at things and still looking at what's going on, but we'll see how it goes.
Well, look, let's blow our own horn here, Andrew. Like when the quality is so high, even if we drop down a little bit, maybe no one will notice.
Exactly.
So, but I must say, you can't see this, guys, because we're only doing this with audio. If we had a video, different story, but you don't seem to have any big black bags under your eyes or anything like that. So you must be getting some sleep. You're doing something right.
Touch wood for the moment. We're doing all right, but we'll see what happens. Apparently, it starts off with a little bit of false sense of security and is apparently meant to diminish a little bit after that. But we'll see. Touch wood, at the moment, everything's going really well. So yeah, no bags under the eyes at the moment.
No, congratulations, guys. That's fantastic news. So kicking us off today, Andrew, we've got something that we've come across recently and probably having a greater and greater conversation with people about this particular topic, just because it's so relevant and offers so much flexibility. But just run us in, Andrew. What are we talking to everybody about today?
Yeah, so today what we're talking about is really ownership structures of how you're holding your assets, in essence. I mean, most people, when you think about how you hold your assets, whether that be shares, property, managed funds, whatever that is, most people think just individual. So you're purchasing an asset, you purchase it in your own name. However, what we're sort of looking at and comparing and contrasting, looking at some of the benefits, looking at some of the costs, but what we're looking at is owning in alternative means. So owning your assets through a company, a proprietary limited, or doing that through a trust, whether that be discretionary trust, a family trust, whatever that is, but comparing and contrasting those three different ownership structures, an individual, a company, and the trust.
Yep. And there's so much to cover with this and there's so much flexibility and we've got some really good examples to cover. I was having this conversation with actually a client yesterday and they're like, oh, why would we go to the effort? And I guess right off the bat, kind of the headline position that I take when I'm talking to people about this is there's really one of two problems that you're trying to solve for. And sometimes they overlap and can overlap, or sometimes you're going in one particular direction first and foremost, and you may pick up some benefit the other way as well. And what I mean by that is really, I think when you're considering ownership structures, the two main challenges that you're trying to overcome is first and foremost is asset protection. So for those listeners that are out there that may be running their own business and they're taking on debts and signing guarantees and things like that, trying to get a little bit creative in terms of the assets that you own, that touch wood, if something goes wrong, maybe those assets aren't exposed and creditors can't come after those if something goes untoward with, say, your business. That's kind of the first thing. So can we offer a greater level of protection by considering a different ownership structure? And then the second one is, which we all love, is the tax that we would have ordinarily paid if it was individually owned. Can we minimize that tax by holding it within a different structure?
Yeah. Love paying less money to the tax man.
Everybody loves that one, I must say. So tax minimization, completely legal to minimize your tax. We're not talking about tax avoidance, which is completely illegal. It's minimizing your tax through the regular legal channels that are available to us. So just get that clear.
And the other thing to kind of make clear in this as well, because it is a question that we do get asked frequently, when we are talking about asset protection, in particular, what we're talking about is protection against creditors. A lot of the times we do get questioned around, what about asset protection in the event of a divorce? So making sure that in the event of a relationship breakdown, that your assets aren't exposed to being taken from another party. This is not going to assist in terms of family law. When it comes to family law, your businesses, your trusts, all of that stuff is exposed. So when we're talking about asset protection, we're talking about asset protection really in the face of creditors as opposed to anything else.
External creditors, not the internal ones, right?
Exactly right.
Yeah. Family law trumps everything. All right, so we might get into the weeds a little bit around this because that will then go towards the tax minimization one, because that's probably easier to explain because we can put some numbers behind it. But looking at the three ownership structures that we've got, individual, company, and trust, there's a different tax rate applicable to all of them. Andrew, run us through what are we looking at with the tax rates across those three?
Yep. So easiest to understand is really the individual one, just because that's what we do every year when we do our tax returns. And what we're talking about in particular is an asset that is an investment asset, because when we're talking about owning an asset that's for an owner-occupied purpose or owning an asset that isn't for an investment purpose, like your principal place of residence or like a vehicle that's a depreciating asset, those don't attract income tax. And so what we're talking about in these scenarios is really investment assets. Now, an individual, you're going to pay individual tax rates on your assets. So when we're talking about owning an asset and when we're talking about tax rates, there's really two elements of tax or two main elements of tax that we're considering. Number one is the income tax. So let's take a property, for example. You purchase a property, and in this really simplistic scenario, there's no debt associated with that investment property. The income that you're deriving from that property is essentially what's going to form part of your income tax. So the rent associated or the rental income will form part of your assessable income, and you're going to pay that on your personal income tax rate. So you're going to go up the brackets through your personal income tax. And then the other element of tax that we're talking about in this scenario is also capital gains tax. So capital gains tax, you purchase that property for, let's say, $500,000. You sell it in 3, 4, 5 years time, and that property is now gone from $500,000 to $700,000. You've made a $200,000 capital gain. So you are going to pay capital gains tax based on that capital gain. And obviously that's going to form part of your assessable income. We are going to talk a little bit about capital gains tax discounts and how that's impacted through different ownership structures. However, there's really two main elements of tax that we're talking about in this scenario. And when we're talking about an individual, it's always just at your personal individual income tax rates.
Yeah, so with that one, you've got the least amount of flexibility with that because the timing of your employment income, if you're employed by someone, it's constant. It doesn't really change. Maybe it goes up if you're in a sales role and you've got some commission-based opportunities. But from there, you're kind of locked in, and however much income that you earn plus your investment income just gets calculated at your marginal tax rate. So least amount of flexibility there. Although in saying that, that is probably the simplest way of doing this. The other one is owning assets in a company or a proprietary limited. So from a tax rate perspective, depending on the size of the turnover of the proprietary limited. Now, if you're operating a business, different story. So we'll assume that it's just a holding asset. You're going to pay 25% tax in that entity. So 25% is what you pay. And then essentially when you do decide to take out that money out of the company and it does land in the name of the individual, if their tax rate is greater than that percentage, you'll end up paying top-up tax. So when you think about that, that's kind of the same as what Andrew was describing if we own it as an individual. But what it gives you the option of doing is it allows some flexibility because you may be able to time when you take that money out of the company that you've paid tax on in an income year when your income is lower.
Yep.
So that gives you some opportunity to try and, I wouldn't say, well, I'd say manipulate, but try and manipulate when you draw that money out. So you're doing it in a year where your taxable income is less. And it's probably no different to timing the sale of an asset. If you're going to pay capital gains on it, maybe you sell it in an income year. Like as an example now, Andrew with Stacey on maternity leave, her income's obviously going down. Potential consideration is if you were going to discharge an asset, sell it in this financial year because her income's going to be lower and you end up paying less tax.
Yep, exactly right. And that's really the main benefit with all of this. The third structure that we're talking about is owning assets within a trust. Now, the trust itself cannot actually hold any funds or cannot hold any profits at the end of a financial year. What will happen is, so let's say you make a capital gain or let's say you make an income from an investment of $100,000 in a financial year, the trust will need to distribute all of that income out. So let's say there's $100,000 profit. You can say, okay, I'm going to distribute it 50-50 between two spouses. You can say, I'm going to distribute 20% to one and 80% to another. You can do 10% to one, 90% to another. So you effectively distribute all of the income out to the beneficiaries of that trust. And what you do is pay your marginal tax rate based on those individuals' income. So exactly what you were saying when we're talking about a company. In a company, once you pull the funds out of that company, then you're going to pay top-up tax based on the individual income tax rates. You're doing the exact same thing in a trust. However, you're doing that every single year, not when you just draw the funds out of the asset. So every single year you need to distribute all of the profits, and all of the profits would be distributed amongst the beneficiaries of the trust, and you will decide who receives the distributions from that trust.
Yeah, so once again, it really ties into flexibility from a tax perspective. From an asset protection point of view, going back to that example that we were talking about before, as an individual, your assets are yours, and if something goes wrong, those assets can easily be targeted. But by owning assets in the two other entities that we were talking about, creates some distance or some differentiation between you as the individual and your assets. And one of the things that you could consider is, if you are in a riskier industry, if you're a director of a business, if you're taking on personal guarantees, one of the things that you may consider doing is putting your assets into a different vehicle rather than your own individual name, just to try and get some asset protection mechanisms in place to try, in the event that something goes wrong, to try and prevent those assets becoming accessible by your creditors.
Yeah. And this is very important to note, that just by simply holding your assets in a trust or in a company does not mean that it's impossible for creditors to be able to access those assets. The way in which I describe this is, imagine you're going into a gladiator fight. You hold your assets individually. You're basically armed with just a sword. You go into the gladiator fight or you own your assets in both a company, or in either a company or a trust. What you now are armed with is a shield. So you're not completely protected. It doesn't mean that you can never be hurt. What it does mean is that you've got a layer of protection to be able to assist you if something does go wrong.
I think Andrew's been spending too much time at home watching TV and watching the HBO special around Game of Thrones, right? So, but you know what? You're right. That's a really good example. Pivoting into an example, Andrew, I might talk about just the flexibility in particular with a trust, just because there's probably a real world example that we're looking at and considering at the moment. But take our business for argument's sake, and if we wanted to buy an asset, and let's call it an office space so we can house our business in, and we wanted to buy it together, and you had less money than I did or vice versa, we could buy that in a trust, particularly a unit trust, and issue different amounts of units to each of the owners based on their proportion of ownership. And that could be a really simple way of owning another asset, but it gives us the flexibility of being able to access that asset. And the other thing above and beyond that is, then if anybody else wanted to buy into that asset down the track, then we could also sell some units or all of our units to that particular person as well too, without needing to sell the whole asset and start all over again.
Yep, exactly right. So really what we're talking about is a huge amount of flexibility associated with starting to hold assets within, really in particular, trusts. I guess the really big thing, and when we're talking about all of this, the main consideration when we're talking about tax, or one of the main drawbacks of holding assets really within a company, that's the main one, are the capital gains tax implications. So essentially, when we're holding an asset for an investment purpose and we hold that asset for longer than 12 months, you do receive a discount. There is a capital gains tax discount when you hold an asset for longer than 12 months. So you do receive a 50% reduction in capital gains. So let's say we hold an asset, or in that exact same scenario that we were talking about before, you buy a property for $500,000, you sell it after 5 years for $700,000, you've made a $200,000 capital gain. Because you've held that asset for longer than 12 months, you get a 50% reduction in that capital gain. So your capital gain is only $100,000. So $100,000, depending on your structure, whether it's an individual or a trust, will go on top of your taxable income, and you'll pay tax on the associated tax rate with that. The thing really to note here, and one of the main drawbacks of holding a property or holding assets through a proprietary limited, is you lose the 50% reduction in capital gains tax discount when you hold assets through a proprietary limited. So really, you think about the types of assets that you're trying to protect. They're usually larger scale assets. they're usually assets that you're doing for the long haul. You're not buying and selling assets. So losing a 50% reduction in capital gains is absolutely massive and really something to take note of when you're deciding on how you actually hold your assets.
Yeah, so a little bit of complexity around all of these things. And I guess it's probably a good opportunity to pivot into some of the other things to take into consideration when we are talking about these different structures. But the first thing that springs to mind is the level of complexity associated with it and making sure that you want to get this right at the start, because it's always easier when you've got the right structure and then you pull the trigger on your purchases and executing your strategy, as opposed to going in one direction and then realizing, hey, we need to change it or we want to change it for particular reasons, and then needing to unwind that position and change tact. It always attracts more cost and delays, more time, complexity, and it's just a bit of a nightmare. So at the start, getting the right advice is definitely the way to go, and trying to figure out of the options that are available with not only the issue that you're trying to solve for today, but if you can also forecast into the future and say, hey, are we trying to solve for a future issue as well? Thinking around the things like taxation and distribution of income, because your asset that you buy today is obviously going to be worth less today than it will be in 10, 15, 20 years' time. Well, hopefully anyway. Thinking about a future issue down the track could be a taxation consideration that's not an issue for you today.
Yeah, exactly right. And that's in everything that we're doing. What we're talking about from a financial planning perspective is really trying to look at what are you doing, why are you doing it, and what's the expectation around this asset moving forward. So if you're looking to purchase an asset, hold it for the long haul, and this is going to form a part of a much larger and broader vehicle, then you may consider things like proprietary limits or proprietary limited or a trust in order to be able to hold those assets so that you can distribute income, so that you can have that level of asset protection because you are planning on going self-employed in 2 years' time. But purchasing an asset, for instance, in an individual sense, and then realizing in 2 years that, oh, hey, this isn't actually the right structure for me, I need to move it into something else. All of a sudden, there's stamp duty implications potentially, there's capital gains tax implications potentially, there's the costs of setting up and administering the transfer of assets. So making sure that you're planning ahead and really clear around what the purpose of holding this asset is and what the intended purpose in the future is going to be is really massive in all of this, because the implications are so large. And so getting it right from the very beginning is really imperative.
Cost to administer is also another consideration as well too. So on the lower end of the investment returns, if you're not getting enough from your investments to cover the additional costs associated with it, then you really need to take that into consideration. And not only is it cost to administer, cost to set up as well, because you're going to need to do this with your accountant, then they're going to need to include that as part of your taxation, not only your taxation planning, but managing your tax affairs as well too each and every year. And then the complexity that's associated with that. So rather than just as an individual needing to manage and track your own affairs, you now need to have better record keeping, and that then forms part of all of your tax stuff that you work on, but there is a greater level of complexity associated with it, which also brings cost as well. So that's another consideration, and that cost is incurred each and every year. That cost will not wait until your investment's 10 times bigger and it can offset some of these things. But there are another couple of things that I think are really relevant to consider, whether your investments are going to be enough to cover the additional cost, whether you've got the appetite to manage an additional entity or entities. And there's ways to mitigate this, but whether or not you've got the skill set to be able to do that as well too, because record keeping is onerous at best. And I don't know anyone who likes record keeping and admin, but yeah, it's a consideration nonetheless.
Yeah. And the other thing to consider as well is once you start going down this road of having multiple entities to house your assets, what you start doing is, let's say you've got a business that's running and operating and you're self-employed. You want another entity that's going to be separate from the business. And so there's an element of separation between your investable assets and the business that's creating an income for you. And so you start down this road with one additional entity. And a lot of the times we see clients with 2, 3, 4 multiple entities down the road. And so the complexity can be exponential. And so it is something to really take note of, that making sure that you're looking at it from a long-term perspective and that it's going to be worthwhile is really important. I mean, I've had an instance in the past where a client has gone down the route of creating multiple entities, moving their assets around so that it's in a tax effective manner, and they were just about to enter retirement, move the majority of their assets into superannuation, which is a 0% tax environment, and the assets that were remaining outside of superannuation was actually going to deliver them less than the marginal tax rate. So really, for them, there was absolutely no need to go down that route. And unfortunately, we only came through the process about halfway through, but they're now left with multiple entities, a significant cost that's involved. But really, from a tax perspective, there was almost no need there was absolutely no need because they weren't going to realize any of the tax benefits given that they were already housing the majority of their assets in a 0% tax environment, and they still had the tax-free threshold to run through as well. So really important to sometimes take a look or take a step back, make sure that you're engaging with the right advisors before you embark on something that just sounds really nice and creative and paints a pretty picture of wealth once you start doing things like that, but ultimately isn't deriving any benefit at the end of the day.
It's funny, we say it all the time, get advice, right?
Get advice,
Yep.
absolutely.
Yep, 100%. Greater control and flexibility, I think we covered off on that one. That's pretty straightforward. We used a good example in terms of the building. We were talking about it if we bought one and what that would look like. The other one that I want to lean into is estate planning. If you own assets or if assets are held individually, obviously that forms part of your estate and needs to get dealt with through your will. But in particular, I want to concentrate on, say, a trust. If you own or if you have assets within a trust, that actually doesn't form part of your estate. So it can't get dealt with through your will. That can provide, depending on what you own and what you want to see happen, and especially when we're talking about family trusts as well too, that can provide a huge amount of flexibility when it comes to managing and dealing with that asset. And it also allows you, I'd say, more flexibility and more options because you're not dealing with that asset through someone's estate. I'm going through a real life example at the moment, but when that does happen, you allow an estate as part of the law in Australia can be contested. Whereas if it sits out of that, it makes it a lot harder to do that and gives you a lot more flexibility in terms of which way you can go with distribution of capital, distribution of income, a whole range of different things.
Yeah, absolutely. Kind of going full circle on this, but on the advice aspect to it, who are the main parties, Bills, that you're going to involve when you're deciding on something like this? Because really, it sounds like there's legal advice around estate planning and around what happens. There's accounting advice. So an accountant that's obviously going to deal with the tax implications and whatnot. And there's financial advice for a financial advisor to really look at the holistic picture around pulling everything together and deciding on what is the right structure for a client in essence. Anyone else from your end that you can say that really should be involved in the decision-making process when building assets, or cover it off on that?
That's probably about it. The only other thing that I'd say, just pivoting a little bit from that, is from the estate planning piece, and only because I'm going through this at the moment, but I think once you've got an idea of what you want to see happen, you've documented that, you've executed on it, you've got your wills in place, you've got your executor, is actually talking to your beneficiaries and telling them what you want to see happen. So if they've got any questions, they can actually ask you at that point in time when they can get an answer, as opposed to trying to interpret what you were thinking and why you did something just on a piece of paper when you're no longer around. I think that's probably the only other thing that I'd add to that. But yeah, they're the three main characters involved in this process. Most people would probably start with their accountant, I imagine, because that just seems to be kind of the natural thing. And then, yeah, it does go a little bit further with the estate planning piece and your solicitor. And then from an investment perspective, yeah, you'd definitely be talking about your financial planner. But if you're trying to get this right at the start, first and foremost, and you do have the patience and the resolve for it, you'd kind of want to get all of those parties together to consider sort of different aspects of their patch of grass, so to speak, and then make a decision on which way you go, as opposed to, hey, I spoke to my accountant, they said I should do this. And then actually, now that I've got that in place, I'm thinking about my estate planning. Okay, I'm going to go speak to a solicitor and, okay, great, I've got the structure. I want to talk about an investment strategy. I'm going to go to a financial planner. That tends to happen in reality, but if you can, and especially if you're dealing with larger amounts of wealth, because it's imperative to get it right at the start, otherwise it gets very, very costly. Trying to do that with all of those people right at the start before you pull a trigger on anything is definitely the way to go.
Yeah, and I know that this is, in many instances, can be a very difficult feat, and trying to do it and actually executing on it can sometimes be a lot easier said than done. But The thing that I'm a really massive proponent on, and I know that you are as well, Bills, is making sure that that circle of advisors around you, your accountant, your lawyer, your financial advisor, your even buyer's advocate, your mortgage broker, all of those parties are really acting in your best interest in order to be able to provide a holistic picture. They're going to have differing views based on their patch of grass. So, for instance, your accountant may be focusing purely on the tax implications on your next tax return, while your financial advisor is looking at your investment strategy over the next 20 years. And so making sure that not only those people giving you their advice, but if you can, getting them in the same room and getting them working on your individual strategy together is really the absolute game changer in all of this, because when those parties are all working together for you, what you're getting is a holistic picture as opposed to just a snippet of a certain viewpoint that someone's taking because something else just isn't within their purview and isn't within their ultimate discussion. So if those people can be in contact with each other and if those people can be sitting around a boardroom table, so to speak, and working on your situation, that's the absolute C-suite.
Andrew, well said, well summarised, and considering it was our first one in a little while, I reckon we did it some justice, my man.
Yeah, absolutely. It's funny how quickly it comes back to you and how quickly you switch back into the mode of things.
It's like riding a bike. To our listeners, thank you for your attention. Hopefully you got a fair bit out of our episode today. As usual, if you've got any questions, details in the show notes, feel free to reach out. We'd be more than happy to take any questions that you've got. And Andrew, thanks. Welcome back.
Thank you. Look forward to catching you on the next one.
Absolutely.
All right. Take care, guys.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.